In this module, we are going to discuss the new fraud section, Section 240. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now the words, how long is the section? The old section had just under 4,000 words. The new section has 5,500 words, 40% increase. Paragraphs have gone from 48 to 68, also a 40% increase. The reading level has gone from 16.1 to 15.1. Both are far too complex and difficult to read, so it continues to be a very difficult to read and understand section. So one would think that significant changes had been made. What does the Auditing Standards Board of CPA Canada say? And here is highlight summary number 47, and this is how they describe the changes. First claim, clarifies and emphasizes the auditor's responsibilities by repositioning the responsibilities earlier and decoupling the auditor's responsibilities from the inherent limitations. Now they did that. They tried to hide the inherent limitations and they decoupled them. In some cases, they've left them together. They say, while there's very little chance of finding fraud, you should still try hard. That's not decoupling. But they've tried to conceal the limitations to make it appear as if we're more likely to find fraud. Now, what a practitioner might do is recouple the procedures with the limitations and or state all the limitations in a checklist. While there are the following limitations, we will do the procedures required by standards, and we'll see if we find anything. The low likelihood of finding fraud should remain clear in your file. Second thing they said, enhances the requirements to reinforce a more robust exercise of professional skepticism when performing procedures relating to fraud. Now, the phrase robust exercise isn't in the standards. What they actually do is repeat the requirement in 200 to do the same exercise of professional skepticism when performing procedures related to fraud. In other words, remain alert. That was there before. It's added to 240. Really doesn't change anything. Now, what the practitioner might do with respect to fraud is add a checklist step saying, I remained alert. There's no documentation requirement for this, but because of what Standard Setters has done, I think you probably want to say, I exercised professional skepticism and I remained alert. Third claim, strengthens risk identification and assessment by adding a fraud lens. I don't know what that means. To the requirements in foundational standards. That sounds cool. And restructuring 240 to follow a similar structure to 315 to demonstrate the interrelationship of the two standards. Now, the two standards were always interrelated, and 315 is about detecting misstatements due to either fraud or error, or both or one or the other. Phrase fraud lens is not mentioned. They've used lots more words. I don't know that that constitutes a fraud lens. To avoid the assumption that we are now more likely to find fraud, I think, again, it appears that we need to, even though we don't have to, seems it would be not a bad idea to document that we did all this stuff. Because the implication is if we do it, we'll find fraud. And if we haven't found fraud, we'll be criticized. Well, you didn't do this particular procedure that standards say you should have done. And you'll say, well, it's not a shall document requirement. Oh, it's a shall requirement. If you'd done that, you might have found it. I think maybe we'd better document that we did all those things. Not hard. We've probably already done them pursuant to 315. introduces a requirement to stand back to reconfirm that fraud-related risks of material misstatement have been appropriately identified, whether the risk assessment remains appropriate, and whether sufficient appropriate audit evidence has been obtained. What did they actually do? Well, the words stand back are only in the highlights. They haven't made it terribly clear what that means. I think it's kind of obvious that it means that you should assess if you've got risk of material misstatement assessed correctly, assess whether it remains correct, assess whether you've got sufficient appropriate audit evidence. But those words are only in the highlights, and they're nowhere else in the handbook. I think what they're talking about is new paragraph 54, which duplicates and refers to 330, paragraphs 25 and 26, which are arguably more complete in the context of reconsidering risk of material misstatement and considering if sufficient appropriate evidence has been obtained. I don't think this is actually a change. What a practitioner might do, though, is, seeing they are proud of their new stand-back requirement, perhaps you will have a checklist step, which you should already have, but do it again saying, yeah, I assessed risk of material misstatement correctly, and I reassessed it, and it's okay, and I've got sufficient appropriate audit evidence. And if you haven't already said it, you should have said it with respect to 330. Nothing wrong with duplicating it and saying it again in 240. The fifth claim strengthens the communication requirement with those charged with governance by adding an overarching requirement to communicate matters related to fraud with management and those charged with governance at appropriate times throughout the audit engagement. Now, what they actually did was added the word appropriate, add a communicate at appropriate times. We were always required to communicate as they now say. Now, presumably we never did the communication at inappropriate times, and if we hadn't done it all, it was not in accordance with the old standard. You might just add the word appropriate to your checklist and say, I communicated at appropriate times. And this is the internal control memo. You will have an internal control memo about internal controls that could allow fraud, if you found any. And you might have specific communication if you find fraud. Sixth claim introduces new ramp-up procedures. They seem to have got really fancy language to describe what they have done. So ramp-up procedures when fraud or suspected fraud is identified, including obtaining an understanding of the fraud or suspected fraud in order to determine its effect on the audit engagement. Now, I'm probably going to say this again, but if you find fraud in an audit, fraudulent financial reporting, and particularly if management is involved, I don't know that ramp-up procedures or anything are going to be any good, because you kind of are going to have to stop and you may have to resign, particularly if management's involved. So I don't know that this does anything, because I think we as auditors were smart enough to know that if we found something like that, we do something specific, tailored to the particular problem. So I don't know that this will help. What they've actually done is they've added generic and general guidance. Basically says if you find fraud, do something about it. The actual procedures would probably be more specific to the circumstances, so you'd probably go beyond what's in standard. And this is only when fraud is found. So the practitioner might use this guidance, though more specific procedures are probably needed. This probably doesn't apply to a checklist, because if you stumble across fraud, you're immediately outside of the checklist and outside of the normal audit environment, and you may not be able to continue. The last claim increases transparency in the auditor's report by communicating key audit matters related to fraud. Now, I'm not sure a page of words saying there might be fraud and we did a bunch of work and we can't tell increases transparency. It's kind of just an excuse for the auditor. Though seeing they are suggesting key audit matters, almost as an automatic, with respect to fraud, even in a smaller audit. Key audit matters are the kind of things that tend to only be included in larger audits, and they seem to have 3 to 5 of pretty much the same key audit matters in everything. A practitioner might consider this even in a smaller audit, just to get you off the hook. Because if you mention in a key audit matter that there could be fraud and we tried hard to find it, but we haven't, perhaps that gets you off the hook. I have to go over the excellent words they have used, because they certainly have used some terrific vocabulary, and whether or not they've actually changed much, they sure make it sound like they've changed a lot. Decoupling, robust exercise of professional judgment, fraud lens and foundational standards, stand back, overarching requirement, ramp up procedures, and transparency. All of those things are obviously good and obviously means something's changed, except as we've just seen, really not a lot has. Now, the International Auditing Standards Board said a bunch of things too. They said professional skepticism is enhanced with a requirement to remain alert. It's mostly the same or perhaps a bit less. Alert was already in 213L as the definition of professional skepticism. There is no change. All they do is quote Section 200, which is already there. Talks about engagement resources and increased emphasis on it. 240.23 and 220.25 through 28 are effectively identical, though those sections in 220 are probably more complete. Trivial change. Engagement team discussion is enhanced. The documentation requirement is the same. There are more words. It is essentially the same. We need to deal with it and say, we had an engagement team discussion and we talked about this stuff. Focus on understanding the entity, sure, but it's the trivial are the same. Trivial are already required. An expanded list of fraud risk factors in the appendix, up to 2,200 words from 1,700 words. No comment. Other changes. Understanding the components of the entity's system of internal control is enhanced. Sure, there are more words, but all they're doing is repeating in 240 everything that's in 315. So there's no real change. Less focus on developing and documenting the rebuttal to the risk of fraud in revenue recognition. This is something where practitioners are going to have to be very careful. Old 23 and new 30 are the same. Old 27 and new 41 are the same, but paragraph 41 drops the reference to the rebuttable presumption, which is now in 68D, which is a shell document section. So they've admitted they're trying to hide this. They are trying to conceal it, which they shouldn't. So they tried to hide it, but it's not true that they've hidden it. It's still there in 68D. And this is something that is very important that a practitioner has to document. Really don't have to do a lot. An analytical procedure will probably do it for you in a smaller audit. So the IAASB has tried to hide this from practitioners. As a practitioner, you can't let them do it because you will be disadvantaged. It says there's more documentation of things, more documentation of the system of internal control. The documentation requirement is the same, essentially the same. There are more words, but it's essentially the same. So that's not really true. Identified and assessed risk of material misstatement now required by 240 and the rationale for significant judgments made. That is exactly the same as required by 315.38D for any risk of material misstatement. So that is also not true. What they seem to be doing is trying to make it look as if this new section will make finding fraud more likely. They, for instance, tried to hide the rebuttable presumption of fraud in revenue recognition. There was originally a plan to say you had to always assume, and there was risk of fraud in revenue recognition. So you had to assume material fraud in revenue recognition all the time. And they took that out because that's probably illogical. So what the practitioner needs to do is contradict both. We cannot, this is not going to make finding fraud more likely, and the rebuttable presumption needs to be rebutted. Now there are 40 requirement paragraphs. Either there was explicit reference to another paragraph already required, that was 21 of them, so that's stuff that's already done. 2 were explicit requirements elsewhere, so those were already done. And there were 17 fraud requirements from old 240. So we basically either done them before or already done. The 21 additional requirements are as required by 315 for fraud and error, do it again for fraud. I don't know that that improves anything. They have rewritten all of 315 into 240. So instead of assessing material misstatement due to fraud or error, or both, or either, 240 is now all about material misstatement due to fraud, and it entirely duplicates 315. So, as a practitioner, you can either do the assessment of risk of material misstatement of either fraud or error in 315, and then do it all over again in 240. Presumably you come up with the same result because you're doing the same things. Or you can just decide that 315 does it, or you can document with respect to fraud in 240, I did this and I've already done it, and it's documented elsewhere. Now a hint for practitioners on the documentation of risk of material misstatement. Because both 315 and 240 say consider the risk of material misstatement of this and consider the risk of material misstatement of that. So there's kind of a long list. And if your practice in filling out a checklist is to document risk of material misstatement in many, many places, the odds are you're going to miss something. My preference is documenting risk of material misstatement, doing the procedures, documenting the procedures, but documenting risk of material misstatement in only one place. And I have seen files with risk of material misstatement documented in many places throughout the file, and 1 or 2 of them were missed. So if you have correctly identified risk of material misstatement, but then you've forgotten to do something about it, you have a deficiency in your audit. So just for self-preservation, risk of material misstatement, my view, should be documented in only one place. All risks of material misstatement should be on the same form, piece of paper, electronic document, whatever, all in the same place. Will an audit find fraud? 738B, which is unchanged, says reasonable assurance is a high-level assurance, but not a guarantee that an audit will always detect a material misstatement, and that's in the report. That's pretty clear overall. 200 paragraph 5 says there are inherent limitations. Evidence is persuasive and not conclusive. That's just a fact. 210.9, which is similar and basically the same as old paragraph 6. The risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one from error. Now, what they've done here is they've said, oh, even though that's true, still try hard. Still do your best. So even though you may not find, try. And I can't disagree with that. Just because it's really hard to find fraud doesn't mean that we at auditors should give up. We should try, we should document, but we have to understand, and everybody else has to understand, we're probably not going to find fraud. To make it even more clear, 240.10, similar to old 6 and 9, inherent limitations are related to fraud. There is an unavoidable risk that some misstatements may not be detected even though the audit is properly planned and performed. So thanks for continuing to say that. Furthermore, the risk of the auditor not detecting a material misstatement resulting from management fraud is greater than employee fraud. So we may not find fraud, and we're pretty sure we're not going to find management fraud because they can manipulate the records. Attempts at concealment may be even more difficult to detect when accompanied by collusion. So we've got a lot of excuses for why we're not going to find fraud. Just to summarize it, not a guarantee. One reason is persuasive and not conclusive. Less likely to find fraud than error. It's an unavoidable risk. Even less likely to find management fraud. And less likely again if there's concealment. So we may not find error. It's less likely to find fraud than error. Even less likely to find management fraud. And less likely again if there's concealment. I think we know that. Now, standard setters seem to be responding to public pressure. And as we talked about at the beginning, all the things they are saying, they are trying to make it look like an audit can find fraud, while at the same time they're being very clear that we can't. I guess the other thing is if these procedures specified worked, then audits would always find fraud. We would uncover every fraud. We wouldn't need the police. Auditors could do it. Now, as audits almost never find fraud, logically the procedures do not work. So because of that, it's more important than ever to document what we have done. So this section is about, and the underlying story about why it's a much better section is we document that we tried really hard. We spend time and do procedures, and we're producing procedures that produce documentation, not necessarily procedures that produce evidence. Not sure that there is evidence of the absence of fraud, but we have to understand in the end, most of the time we're not going to find it, unless it's really obvious. And these, I think, are the situations, the public situations, where the auditor missed something, and everybody said, how could you have done that? It was really obvious. Now let us take an example. Receivables in the GL are 6 million some, down to the penny. Sales in the GL are 51 million something. And we probably go 51 million in sales is monthly sales of 4 million. Receivables look to me a bit high. I'm not quite sure about this. The year-end entry is debit accounts receivable $500 million. Credit sales $500 million. This was a real case. It was fraud. Resign. Another real case. Receivables are 12,000. Sales are 18,000. Again, receivables seem to be a bit high. On December 31st, we make a journal entry, debit accounts receivable 14 million, credit sales 14 million. Before that, we were in a loss position. It's fraud. Resign. You are looking at the retail sales tax return. Retail sales tax is 7%. December sales were $243,000. Off the top of your head, you should say tax should be 14,000 something. 7% is actually 17,069.30, but we've got the scale of it, 14 to 17. The return shows tax collected of $52. We look at all the other returns, they're all the same. We know this company, it sells stuff locally, all of it. Everything is sold is subject to retail sales tax. It's fraud. Resign. Now these are all real frauds. I've exaggerated the numbers a bit, but they're roughly what you would have seen in the audit file. The first two were big firms. The third one was a smaller firm. In all three, the partner missed it. The firm missed it. In all three, the judge said, how could you have missed that? It's plain as a nose in your face. Why was it missed? What in the firm structure let this happen? And that's a question I think each of us needs to think about and think about in the structure of our firm. If this happened, would we miss it and why? As an aside, despite all the stuff this section is going to have us document, analytical procedures are probably the best. And when you looked at these cold, you went, how could you have missed that? Well, firm documentation, procedures, file review, it hit it somehow or other. I think we're going to find that analytical procedures are probably the best. They are, in fact, very powerful procedures. Before the audit begins, used during the audit as substantive procedures, and as a final check as the partner is looking at the financial statements and reviewing the file. Does this analytically make sense? Second best is probably knowledge of the business. Now, it's now called understanding the business. I like calling it knowledge of the business. If the partner had understood the business in each of the three cases, they would have said, that just can't be right. So this is partner level stuff, and somehow or other that got missed. In fairness, and I'm complaining a lot about all of this documentation, and I don't think we can. I think we just have to do it. Can we say, well, fraud is really hard to find, so we're just not even going to try? I don't think we can say that. That's not fair to the public. We have special knowledge, special position. We should give it a try. So I think the next thing we say is, well, we tried really hard, even though we knew it probably wouldn't work because it never does. So we tried. We spent time and money, charged you a fee. The level of work we're doing, was it a level of work that we thought was reasonable, or was it higher than we thought was reasonable? And perhaps I'm going to say, maybe I think the level of work we now have to do is higher than I think is reasonable. Can we say that? Well, I don't think so. Or we can only say it if we're told to. Well, we did the level of work that we were told to do by standard setters. So don't complain that we're doing too much work. Don't complain that our fees are too high. What we're doing is fair. So I think what we conclude in the end is, well, standard setters representing the public say, try really hard, bill accordingly. Have they said that? Yes, they have in new 240. Is that in the public interest? I guess we have to agree that it is. And if a client says, why are you doing all that work? You know you're not going to find anything. We say, well, it's in the public interest that we do it. So we are. What does a practitioner do in response to this new section? Well, the first thing I think is you need a checklist that documents every single thing in standards. If it says you shall do it, you do it and document it. Whether it says shall document or not, think in protection of yourself as a practitioner, do it and document it. Now, most are already done or required. So it would be nice if you could say, well, I don't have to do anything different. I think they've decided to make 240 stand completely alone from 315, which requires the same thing. We document 315. Let's document 240 as well. There are some new things. Do them. Consider the completeness of adjusting journal entries. You need a checklist step. Do it. Particularly do the shall document items. And in a smaller, simpler audit, we're going to have to complete the checklist, but I don't think it's going to add much additional time. If we're talking a large multinational corporation, which is substantially more complex, and where fraud could be more easily hidden, big firms are going to have to spend a lot more time, and they are going to say to their clients, new standard on fraud, we're doing what's required. Maybe even going to put a key audit matter in the audit report to say it's really hard to find and we might not have found it and here's all we did. But in a smaller, simpler audit, perhaps not much more time. The question then is, should we early adopt? We can wait until years ending December 31st, 2027, which is not quite as far away as it used to be. Now, we're probably as likely to miss fraud under the new standard as the old standard. The standards are very, very similar. We're probably going to be documenting a lot more under the new standards than we did under the old, or maybe not. But I guess the question is, if we adopt the new standards early, and we miss fraud as we always would have missed fraud, and we end up in court, can we say to the judge and the jury, well, we adopted the new standards, which substantially improved the chances of us finding the error? It was more work, but we did it. Or could someone say, well, if only you had adopted early, you probably would have caught it. Wouldn't you agree that perhaps you could have caught it? Don't know the answer to that. Certainly in a bigger audit, the bigger the audit is, the more work there's going to be, the more additional stuff there's going to have to be. In a smaller audit, maybe not so much work. But certainly this is something that needs to be discussed with the client, because they're going to need to understand the impact on fees, the impact on work we're doing. So we should probably start discussing this with clients now, get checklists that are updated so we understand what we're going to be doing and what the differences are. There are some subtle differences, but we should start doing that now. And I don't know whether we should early adopt or not. I don't know which is better. So, thanks for listening.